Welcome to the next decade of Market Buzz. I'm Greg Schnell, the Canadian technician and the host of this unique show. We look for long time frame trades on weekly charts so that you can see the bigger picture. Please follow me on Twitter at Schnell Investor or on gregschnell.com. So I want to cover off a couple of things today. Obviously, we had a small pullback yesterday, one every 2 weeks or whatever, no big deal. We're between option expiration Friday, which was last Friday, and I think I spelled meeting wrong, but the Fed's meeting next Wednesday, Tuesday, Wednesday, so we should hear from the Fed then. The banks, I'm going to show you a Don't Ignore This Chart article that I wrote last night. I think it's pretty important, so I want to cover it off a little bit more thoroughly today. I'd also encourage you to check out the final bar with David Keller. I was on his show last night, so that would be Tuesday the 21st. And so try and make sure that you see that show. It's got some implications around the Baltic Dry Index and commodities. So I think that's something pretty important. But we're going to jump into the consumer discretionary sector and just try to figure out the overall health of that area, because it's a pretty dynamic area in the market. It's one of the more fun ones to watch as well, because so many of the brand names are brands we use and know. So lots to get to. So let's jump into the charts. So my point here, so the banks are kind of stalling at a lower high here. And what I mean by a lower high is they made this high back in 2018, and they pushed up in March and then tried again in June and then tried again in September. You might remember that this drop in 2018 was also when the overall market dropped and it fell pretty hard. So what we've got here is an uptrend in momentum that's getting close to signaling a turn down. And the other problem with that is it's a lower high. Now, on a shorter period, so less than 2 years, it doesn't look like that big of a deal. I want to zoom out a little bit and show you a little bit more. So here's the chart broadened out, and it adds a little context to the lower high. So what we have here is a big uptrend, and we have to remember the stock market's gone way up. And this is struggling to get through prior highs. And it's also the highs back from 2007 was $47. Now, this is a total return chart, so it changes history by adding in the dividend every time. But the point I want to make here is we're making this lower high, and we made a lower high in 2018, and that's when the market corrected. And now we've come up, and after, I mean, there couldn't be much more euphoric. Everything is literally flying higher. And yet 6 weeks ago, we stopped making highs on the banks. So something's odd. And we just had JP Morgan, Citigroup, Bank of America, Goldman Sachs, Morgan Stanley, all kind of the names we know, just report last week. So lots of data coming out, and yet this chart is still stalled. So a little bit of a concern and a point I want to make. So anyway, you got this downtrend here in momentum, and we've got this uptrend that I showed you on the chart above. So this chart is the same as the one up here. You can see this uptrend and then the price uptrend that we're watching. So here's the uptrend in price, and then here is the momentum. And so again, we haven't broken down yet, but my point is to look at a what-if scenario. And the reason for that is in 2007, the banks made a lower high while the S&P made a higher high, and that was an 83% drop in the banks, okay? So that was that one, not calling for anything like that. But then if we look back here and see in 2011, the banks made a lower January high while the S&P made a higher high. So that's here. The banks struggled, so roughly a year apart, and then they fell. In 2015, there was no real divergence. So the banks were kind of going up. As a matter of fact, if anything, they were doing a little bit better, but they made a high, then a lower high, and so did the stock market, a high and a lower high. It all ended up resulting in a 24% drop. And then in 2018, so while the banks went on to make lower highs within the year, the S&P was making higher highs in September, and we went on and we had another drop, and in that case, the banks dropped down 29%. So now here we are. What if in 2019, the banks make a lower December high while the SPX makes a higher high? And that's kind of what we're sitting at roughly a year apart, right? So we had the October high from 2018 going into the December high of 2019. And in the meantime, the stock market has, moved up pretty dramatically. And yet we don't have the same thing in the banks. So my point would be not predicting any sort of a crash. We don't even have a cross on the signal yet in the banks up here. But again, we just be aware that when the banks start to be weak, and one of the points I would make is that a weak bank stock is a pretty important clue for us. And I explained this in this article, but when I was in New York for one of the first trips with the CSTA Association Symposium, one of the bank technicians told me, look, everything's fine as long as the banks are fine. But when you start to see the banks underperform, that's when you always need to dig deeper and ask more questions. So until now, we had that beautiful October to December rally with the banks. I think the important thing to notice is, all of a sudden the banks went on this real roll for 3 or 4 months where they started to outperform. And then look what's happened over the last 6 weeks. They've really started to underperform dramatically. And we're at conditionally, we're very close to making new lows on the banks in terms of relative strength. That isn't what we want to see. And we need to stay tuned for that. So in general, I would just say the banks are starting to give us a signal. Again, we don't even have a cross on the signal line yet. And we have a little bit more to go in momentum. But if we had a big pullback, whatever, 1 or 2 weeks, this would probably click over and give us our sell signal. So pay attention to that chart. This is the KBE. Again, just using the average bank stock, but I mentioned it last week in the Market Buzz show that, the financials, the banks weren't doing as great, and it looked like there was a rotation into the asset managers and investment managers. The problem now is that this signal on the banks is starting to become clearer, and we just need to be aware of it. Okay, so today I want to cover off the consumer cyclicals whole sector, and I just want to show you what I did here. So first of all, I used volume first, then the scooter ranking, then industry group. And what happens is when you sort by this, it allows you to see how many strong stocks are in a given area of the market. So these are all consumer discretionary, so we don't need to show the sector. But the industry group, apparel retailers, and apparel retailers is difficult because they're actually, you've got apparel retailers, clothing and accessories, footwear, specialty retailer. So they're kind of 4 different areas, broadline retailers, 5 different areas that you're going to see these retailers. So it's not quite as clean as we'd like it to be. But I will say that there's only about 10 of them with a scooter ranking in the top 10 here. And the charts aren't great, but when we scroll down, auto parts, 4 or 5 out of the 20 are doing okay, so not very good. This one jumped up today, so something must have changed there since I sorted them this morning. And then automobiles, what we're seeing here is Tesla's clearly way out in front. We'll talk a little bit about how to manage that Tesla trade. And then broadline retailers, you can see way up here, there's 3 or 4 of them that are doing pretty well, and then the rest of them not so much. Business training, only 1 up in the top 25%. This Corn Ferry chart isn't broken, so it's okay. And then Lululemon, clearly one of the stars in the clothing and apparels right now, and Carter Holdings. Those 2 are the top ones. The Lululemon chart's actually okay. Doesn't look as bad as 52% might make it look, but a lot of them are just horrific. And so I think that's always important if you're talking to millennial investors, to help them understand that just because they like the brand doesn't mean that it's a great one. So as an example, J. Jill, that chart's quite weak. Anyway, looking through different durable household products, what we see here, Newell Brands is kind of the leader up here. Only 3 of them are kind of okay, and then the rest of them fall away pretty quick. Whirlpool's got a scooter ranking of 28%, and that's an important chart, I think, just for durable household products. iRobot, I was shocked to see how weak that chart is. And then you've got Crocs down here. Crazy. Who would have thought that chart just keeps coming back, but it does. Nike's doing pretty well. Then we've got Wolverine Worldwide and Steve Madden. All of those charts are okay. Deckers Outdoor and Skechers, middle of the pack, right around 50%, so just kind of in the center of their range. And then lots of stuff in home furnishings, most of them bed related, that are making the big money. And then you get down into office furniture, not really doing anything. Gambling had a big knock yesterday with the China virus going around, but some of those charts are still okay, so we can talk about that. But home construction obviously has been doing well. This is a knockout. Every single stock in the group is in the top 25%. So usually when a group gets that strong, you can expect more strength. So I would encourage you to look in there. Home improvements down here at 94% for restoration hardware. I was surprised to see how strong they were. BMC stock, I am not aware of that store, so I'll have to do a little bit more looking. But looking at Lowe's holding up at the 75% level, that's pretty good. Home Depot at 68. So still okay. This lumber liquidator chart is terrible. Wayfair actually looks to be improving. It's one of the charts I wrote down to look at as a more interesting stock. And again, we're just using the scooter ranking here to kind of sort them. All of the hotels didn't have a lot of magic for me. And as you can see, only 2 of them are above 75%. So really not that great. Recreational products, Thor Industries and Nautilus, both of those are really nice charts that are looking good. Camping World, the chart is definitely turning up. So might be something there. Winnebago is testing a prior high, so not that great. Anyway, as you can see, quite a few of them are up above 75. And then all of a sudden, kind of there's 4 or 5 here that drop away. And GoPro, probably another millennial product, terrible. Polaris, what do you call it? ATVs and snowmobiles and that kind of thing, sleds. The chart's horrific. SeaWorld, I was surprised to see it being one of the top charts out there. It broke out to new highs and continues to climb. But looking at the rest of these, they're just average, nothing really interesting there. IMAX is terrible. Going through the restaurant and bars, this Habit looks like a buyout of some sort, but Aramark Food Delivery, Papa John's, remember when this stock was down and out? Well, now it's up near the top. Chipotle is just falling below the 75% level, so interesting to start to watch that one. But as you can see on these, lots of the restaurants are below average and the charts don't look very good. Special Consumer Services looks a lot better. There's a lot of interesting names in here, sitting up around 94% for some of these educational ones. New Oriental Education, these things have been on the lists for a long time. Weight Watchers, the chart looks not as good as this 86% might say. And so Mercado Libre is still up over 80%. That's not bad. 58.com is interesting. Anyway, as you get down in here, these ones fall away pretty quickly and there's not much to love. TrueCar, I was surprised to see how weak it's definitely at. Looking down here at Tiffany, what you see, obviously they had the buyout, so that chart looks strong, but really it's just because of the buyout. And then we go into Bed Bath & Beyond, actually. Who knew that would be one of the top ones? But Bed Bath & Beyond, Best Buy, Dick's Sporting Goods, in terms of these big warehouse stores are okay. Office Depot at 79% must be a surprise to everybody. Williams and Sonoma breaking out to new highs, so really nice. My point is that when you go through and just use the scooter ranking to help find and sort the stocks and then get into the groups, I mean, these container stores have been terrible for a long time. The AutoZone chart, it's up in the thousands, $1,100 stock, but that chart is only at 20% for a scooter ranking, so it's not doing much while everything else is surging. Ulta Beauty used to be a big one, clearly out of favor. And so one of the things we can see just by looking at the scooter rankings is how the names that we know are performing or not performing. And one of the surprises for me was travel and tourism in general, not just from some sort of China virus for one day. These things have been down and out for a while and still don't look very good. So let's jump into the charts now and just I'll flip through some of them. But here's Signet Jewelers. So this one, because of this big spike here, scooter ranking has jumped up. It's not exactly the greatest chart to lead off with. Here's Guess Clothing, and you can see it's stuck at a prior high, trying to get through that right now. We'll see if it's got any strength. Shoe Carnival, so this isn't in footwear, which surprised me, but it's in apparel retailers, and it's stuck here in the middle of this kind of price action. Hasn't done anything for 10 weeks while the market's gone higher, but it is having a bit of a surge this week. Express Clothing, I think this is just a dead cat bounce, and so not really looking that good. Here's Buckle. This one took out new prior highs, which is nice to see. gone sideways for the last 10 weeks. So after the initial surge in October, November, it's kind of lost its mojo, starting to get a sell signal here. Nothing I'd kind of want to look at this point in time. Burlington Stores, this is just a beautiful chart that just keeps climbing. Looks like it's probably, had 3 or 4 rallies in here trying to hold up. I'd probably make sure I protected profits there. Boot Barn, here's another one in the apparel retailers rather than footwear. But what you see is sitting up nice and high. New 5-year highs. That's a pretty nice stock. Nothing wrong with that. Nordstrom had a nice rally off the lows, and now it seems to be losing its momentum. You can see the histogram been dropping for about 10 weeks. Chico, pretty weak. Zoomies, this is kind of where the charts start to break down. So we're at a scooter ranking of around 71, and the rest of them start to get weak. But we're just trying to hold this trend line here, and the momentum trend is starting to fail. Okay, Land's End. So all of a sudden we go to 64%. This doesn't look very investable. TJ Maxx, this is a nice chart. One of the things, it really hasn't done anything since the October rally. So that's a bit of a surprise. It's underperformed everything. And so I don't want to see this trend break in TJ Maxx. Let's just annotate that. One of the things we should see is the stock should continue to outperform the S&P 500. This is a year-long trend, and we want to see it hold. But again, it has done, relatively speaking, nothing while the rest of the market's kind of surged higher. It's still at a new all-time high, don't get me wrong. It's a pretty nice chart, but I wouldn't want to start to see this break down at all here. It's starting to show some, I'll call it, move from being better than average to just average or below. So I'd be cautious on that one. Ross Stores is such a nice chart, just continues to drip higher every week. And then Cato, this one's pretty much rolling over, nothing you really like. Caleres rolling over, Urban Outfitters rolling over, Genesco. And you can see how the scooter ranking is kind of, it does a pretty good job of filtering the names. Abercrombie and Fitch hasn't done anything for a while. Designer brands pretty much drilling in the bottom right-hand corner. Gap store got a bounce to new 3-month highs, but just barely at the 40-week moving average. Doesn't look very investable. Okay. American Eagle, this is a popular name in the malls, but what we don't see is that it continues to break down. I'll call it, it's an important trend chart, but we're still not seeing any sort of price action. So anyway, what I wanted to show you was how the scooter ranking fails. And now we're going to go, after we take a quick break, we're going to come back and talk about some of the other names. So we'll be right back. With motorcar parts, and here we're starting at the top here. It's up around 79%, but as you can see, it hasn't really broken out to new 1-year highs yet, so it's not that great. This Gentex chart is nice, smooth climber, holding up around 75% scooter ranking. And you can see in general it does okay at following its peer group. It just kind of sits in the middle. These dips down to 10% obviously would have been hard to hold through. There's a trend line right here that needs to hold on this chart, and a relative strength trend here sideways for 3 or 4 months that really needs to kind of keep up with its peers. So it wouldn't be my favorite, but it's still an okay chart. This Gentherms recently had some nice momentum to the upside. LKQ, this chart's just so gappy and ugly. I think I'd avoid that one. Lear, trying to start to turn up new 6-month highs, but really looking at the rest of the market, this chart's just hard to own. Magna International stalling at prior highs. Autoliv stalling at prior highs. Superior Industries not really getting to any sort of highs. Aptiv rolling over again. A lot of these charts in the auto parts sector don't look very good. Now again, other areas like specialty retailer, you'll see some of the other names. AutoZone is down in there. Anyway, this whole area is not that great. I want to jump into autos and just quickly talk about Tesla. And so I think that's going to be over here. I went one too many. Okay, so at the bottom of this list, and I'm just going to quickly get there. I was surprised to see how weak American Axle is actually as a important part of the car business or of the automotive business. Borg Warner pretty weak. Cooper, um, just drilling in the bottom corner here, nothing. So here's Tesla. And one of the things I want to point out is look at the 2 last weeks in terms of volume. So there's been short covering, and it's the most highly shorted stock right now. I did some math yesterday, and currently for every car they sell, the stock has a $265,000 valuation, whereas Ford, for every car they sell, has a $6,000 valuation. So we're a little bit over the skis here on Tesla. And one of the things, if you start to see, obviously the price trend, if it broke, would be all the way back through 500. I'd be a little bit more worried about this parabolic relative strength compared to the S&P 500. And if that line started to break, I'd at least lock in profits or buy some puts or something to try and make sure that you're holding the stock and don't have to endure a bit of a pullback. This looks like a short covering where it continually pushes higher and forces the shorts to cover and cover and cover, and eventually that rolls over. Ferrari is about the only other car company that looks any good right now, and it's trying to get through its prior highs here. It's still okay. Scooter ranking's only at 50, and then the rest of the car companies disappear. We're going to jump down into the broadline retailers, and VIP Shop kind of leads the group here. And one of the things on this is it's pretty much average, but it's been a really nice run for the last year. I wouldn't let this momentum trend start to roll over, and it looks like we're going to get a signal pretty soon here. Got to wait for the end of the week on a weekly chart, but doesn't look that great. JD, this one's really starting to turn up nicely. Made a lower low and already a higher high this week, so it's looking good. Alibaba's struggling to get much higher than its previous highs. It's really kind of hasn't done anything for the last 5 weeks, so just pay attention to that. I thought it might be, off to the races, and it's kind of paused there. Target's in a clear breakdown for me, and I mentioned this stock a couple weeks ago, but looks like it's definitely rolling down. We're already down at the scooters at 40%, so a lot of those don't look that good. I'm going to jump down to clothing and accessories. Actually, let me just finish these. PriceSmart and Amazon. Amazon's an interesting one here. I put the zoom panel over here, and what you can see is, remember, the stock market's been going higher. So Amazon's just stalled here for the last 4 weeks, and the real question is, can it start to break out? I don't think there's anything wrong with the stock. I think if they can start doing drone deliveries, all of a sudden this stock's got some huge profit, because their biggest cost is the last mile. So I'm interested to see that one. Macy's is a no touch. Okay, so we wanted to jump down here. I've just got some notes on the side. Clothing and accessories. So I want to get to 840 here. Here's Lululemon, and obviously that's been one of the nicer charts out there. We've mentioned it before, but Carter Holdings kind of stuck in this range. Unify, this is okay, but it's already getting a sell signal on momentum, so I'd be very cautious. Polo Ralph Lauren still making a series of lower highs and lower lows, so not exactly the uptrend we're looking for there. And we're quickly into small scooter rankings here, so that's not so good. I'm going to jump up to Whirlpool. Actually, I should finish going all the way down to the bottom of the column before I jump around. Whirlpool is going to be halfway down this list, I think, if I'm not mistaken. Anyway, let's just check the bottom. But look at all of these charts. The scooter rankings are weak. They're pretty ugly. Here's Newell Brands, a little bit interesting. Helen of Troy has been okay. Central Garden, pretty much sideways. Accio Brands, nothing there. And then here's Whirlpool. And what I want to point out on Whirlpool is you can see that it made higher highs back in 2017, 18. It really hasn't been able to follow the big breakout so far this year. And that surprises me. So now we're resting on an uptrend line, starting to have underperformance and relative strength here. It's not really what I want to see. So just make sure that this stock stays positive and doesn't get into negative territory. So that's an important one. We're going to head off to footwear here. There's 6 footwear stocks, and they're all in great shape. Let's go one more here. Wolverine worldwide, again, it's okay. It's starting to roll over, but the this area has been pretty strong in the market. Got a sell signal here on Steve Madden, just rolling over in terms of momentum. The uptrend is starting to break, so I think that one's a little bit more protective. Deckers is still trying to get through prior highs, but you can see momentum is quite weak here and starting to make lower highs, so I'm not that comfortable. And Skechers has actually rolled over and given us a sell signal, and it's breaking this uptrend in momentum as we try to get through prior highs. So as much as it looks like a relatively good stock, it's starting to give us the signals that Target gave us 2 weeks ago. These bedding manufacturers, Leggett and Platt, big surge and then nothing for the last 6 weeks, which is kind of odd. Sleep Number trying to get through prior highs. Tempur-Pedic, same thing, trying to get through prior highs. Again, all of these charts are pretty good and the profit margins are obviously holding up. Office furniture, it gets weaker. These charts don't look very good. Knoll and Herman Miller's on the next page. I'm going to skip forward to some of the recreational products. And the reason I want to go there is this Nautilus chart. Thor looks okay, but this Nautilus chart was one of the more interesting ones. It's been sideways for 5 years, nothing going on, really had a big downtrend. And now all of a sudden it looks like they got something going on that might be worth investing in. So that's at least a place to go and start to hunt down. Camping World, this chart's getting a little bit better. Here's Winnebago, as I mentioned, testing the prior high. I want to make sure that this chart gets through there. That would be an excellent place. I mean, it was a pretty good signal. Once it starts to roll over, you probably want to be aware of that. So stay tuned on that one. I still think this Eastman Kodak is pretty weak. Here's Fitbit, nothing really going on. Garmin, trying to make higher highs here. Momentum is starting to roll over, so that's a bit of a question mark for me. Anyway, my point is going through these consumers, we're starting to see some of the stocks rolling over, and a lot of them have a slow uptrend here that's starting to get tested. So just be careful as the retailers go forward. A lot of times they'll run into March, but we're not quite getting that far out. Lastly, when consumer discretionary rolls over, so when we go to XLY here, the big thing to be aware of in all of these is, you got a nice uptrend, and if we're going to start losing momentum, this is where it would start to show up. And so just be careful as the market continues to extend itself to new highs. Make sure that that this doesn't start to fade on you, because I think that's probably one of the more momentum-driven groups, and when all of a sudden the momentum falls out of it, then we might experience more trouble. So I think it's an important place in the market. Try and stay on top of that one. I'm going to go get one more chart, and this is totally unrelated to what we just talked about, but it's what I covered off on the Dave Keller show yesterday. And what we see here is the Baltic Dry Index, and it's pulling down and starting to break this 4-year uptrend line. And this red line is the metals and mining ETF, and it's starting to crack here. And you can see that normally it might follow a little late, but it does follow. So with all of that, I think that adds up to an important perspective. I'd encourage you to go see that Dave Keller Final Bar show. Some really good information there. But I think this chart is particularly important as we go forward for copper and some of the other metals. Thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesdays and Fridays at 10:30 a.m. Eastern. You can also see the recordings on StockCharts TV YouTube page. You can also find my US and Canadian market reviews on the StockCharts YouTube page, as well as on gregschnell.com. Go in there, put your name in, and when I write new blogs, you'll get an email just saying there's a new one out. So thanks everybody for joining me. Have a good rest of the week. Fed meeting next week.